You want to buy an insurance company because you are a millionaire. Most people go wrong when they think to own it. And I mean most people, including some people who actually tried to do this. They think insurance is boring. It's for risk-averse people, bureaucrats in cardigans. It's the industry that makes you fill out 6 forms to get reimbursed for a $40 prescription. But insurance is one of the most sophisticated money machines ever constructed by human civilization. And the people running these companies? Some of them are quietly printing money in a way that would make a hedge fund manager genuinely uncomfortable. Let me show you exactly how it works. When you buy an insurance company, you are not buying a business that sells safety. You are buying a legal license to hold other people's money and invest it before they need it back. That's the actual product. Here's the mechanism. You write policies. Customers pay you premiums every month, every quarter, and every year. Now those claims? They don't all come in at once. Some of them won't come in for years. A life insurance policy might not pay out for decades. A liability claim could be tied up in courts for 5 years before anyone writes a check. So in the meantime, all that premium money just sits there? Absolutely not. You invest that, right? This is what Warren Buffett calls the float. And it's the reason he built Berkshire Hathaway around insurance companies, starting with GEICO in 1996. The float is the pool of money held between when premiums are collected and when claims are paid. U.S. insurers collectively held nearly $9 trillion in cash and invested assets by the end of 2024. That is not a typo. $9 trillion sitting there for being invested. At year-end 2024, U.S. insurance companies reported total cash and invested assets of $8.98 trillion, a 5.3% increase from the prior year. That's the secret. The premiums are almost secondary. The real game is what you do with the money while you're holding it. Progressive, which most people think of as a car insurance company with a quirky mascot, generated investment income of $917 million in just the first quarter of 2026 alone. One quarter. $917 million from investing the float. So how does the economics of this actually break down? Insurance companies make money through 2 channels, and you need to understand both. Channel 1 is underwriting. This is the math of risk. You collect premiums, pay claims, you keep the difference. For underwriting revenues, insurance companies take the cash collected on insurance policy premiums minus money paid out on claims and for operating the business. If you collected $5 million in premiums and paid $4 million in claims, you made $1 million in underwriting profit. Simple enough. But here's what most people don't know. Plenty of insurance companies are okay with losing money on underwriting because Channel 2 makes up for it. Channel 2 is investment income. When an insurance customer pays their monthly premium, the insurance company takes the money and invests it in financial markets or other types of assets, such as real estate, to increase their revenues. Insurance companies tend to invest the most money in bonds, but they also invest in stocks, mortgages, and liquid short-term investments. The bond-heavy approach isn't timidity, it's strategy. You need predictable returns because you need to know the money will be there when claims come in. Bonds made up about 60.4% of U.S. insurers' total invested assets at year-end 2024. The beautiful thing about this model is the timing asymmetry. Some insurance products have long tails, meaning the time from incurred loss to claim settlement could be quite long. Therefore, the insurer has more time to invest and earn a return. And for some P&C contracts, it's possible a loss event may never occur during the policy period at all. You collected the premium, no claim ever came, you keep it all and the investment income on top. There's also one more profit mechanism that never makes headlines: policy lapses. All too often, consumers fail to keep current on their insurance policies, which triggers a profitable scenario for the insurance company. Under the insurance policy contract, a policy lapse means the actual policy expires without any claims being paid out, and all previous premiums that are paid by the customer are kept by the insurer. With no possibility of a claim being paid, you forgot to pay, they keep the money. Nobody reports this on the news. If you're starting from scratch, the barrier to entry is lower than most industries. Starting an insurance company typically needs $50,000 to $500,000 in initial capital, depending on your planned scope of operations and business model. But that's the floor, not the ceiling, and in real life the floor is a trap. The regulatory requirements vary massively by state and by what type of insurance you want to write. New York, for example, requires a life insurer to have paid-in capital of at least $2 million and surplus well above that. If you want to write reinsurance or cover risks internationally, you're required to have surplus to policyholders of $35 million and a deposit of at least $3 million. And state regulators are not optional. Every state has its own insurance department, its own rules, its own reserve requirements. If you want to operate nationally, you're filing for licenses in 50 different jurisdictions, each with their own bureaucracy and timeline. This is not like opening a restaurant. If you're buying an existing insurance company, which is the smarter move, you're talking about acquisition premiums on top of book value. Mid-size regional insurers can run from $100 million to several $1 billion depending on their book of business, reserve adequacy, and what types of policies they've written. The smart play that private equity firms and sophisticated investors use. Acquiring fragmented regional players, especially those focused on local self-insured public authorities, and expanding across the claims value chain to realize scale efficiencies and gain access to higher margin businesses. Buy the small guys. Consolidate. Extract scale efficiencies. Invest the combined float more aggressively. Private equity firms have entered the life insurance sector specifically to manage large pools of underlying assets and boost asset returns through their specialized investment skill sets and asset origination capabilities. That's the playbook. Buy the insurance company. Use the float to fund your actual investment strategy. The insurance business is the vehicle, not the destination. Now, every one of these videos has a moment where we get into what happens when someone takes the logic of insurance ownership and pushes it past every legal and ethical line. Greg Lindberg was Yale-educated, North Carolina-based, founded a private equity conglomerate called Eli Global. In 2014, he made his first insurance acquisition, a burial policy insurer in Alabama, and he immediately understood what insurance ownership really meant: access to a massive pool of investable assets. He wanted to invest those assets in his own companies. Lindberg wished to loan the insurer's assets to other businesses he owned, but the number of the company's assets he could invest in affiliated enterprises was restricted by Alabama state laws. Lindberg then relocated the insurer to North Carolina, where regulations on such practices were vaguer. North Carolina normally enforced a cap of 10% of assets that could be invested in affiliated entities. Lindberg eventually negotiated a special agreement allowing him to invest up to 40%, and then he blew past even that limit. Between 2016 and 2019, Lindberg and his co-conspirators caused companies he controlled to invest more than $2 billion in loans and other securities with his own affiliated companies. He was essentially using policyholder money, the money real people had paid for their life insurance and annuity products, as a personal line of credit. Lindberg directed the scheme and personally benefited from the fraud in part by forgiving more than $125 million in loans to himself from the insurance companies that he controlled. He used his ill-gotten gains to fund a lavish lifestyle, buying private jets, mansions, and a 214-foot luxury yacht. But the audacity didn't stop there. Lindberg and his associates began meeting with North Carolina Commissioner of Insurance Mike Causey to discuss reassigning the Deputy Insurance Commissioner who was regulating his firms. They promised that in return, they would give Causey millions of dollars to fund his re-election campaign. What they didn't know: Causey had already informed law enforcement and was working with the FBI. Lindberg was sentenced to 12 years in federal prison and ordered to pay approximately $1.6 billion in restitution, one of the largest financial penalties ever imposed in a North Carolina white-collar criminal case. Among the most affected were his North Carolina-based insurers placed into rehabilitation or liquidation. Colorado Bankers Life Insurance reported a deficit exceeding $1 billion. Bankers Life Insurance showed a shortfall of roughly $240 million. Southland National Insurance had a deficit of about $144 million. Thousands of real people, retirees, policyholders, people who bought annuities believing their money was safe, are still collectively owed more than $1 billion earned. A Yale economics graduate, bought real insurance companies, used them as a personal ATM, got caught because the regulator he tried to bribe was already wired by the FBI. The float is powerful. It's also apparently very tempting. Let's say you're doing it the legal way. You still need to understand what can destroy you. Risk 1 is catastrophic loss years. Insured catastrophe losses in the United States reached $112.8 billion in 2024, the second highest figure on record since 1999, surpassed only by 2017's hurricane-driven peak of $131 billion. All 5 of the most costly catastrophe years on record occurred between 2017 and 2024. Climate risk is now actuarial risk. Your models assume historical patterns. The climate is not cooperating. Several insurers have already exited entire state markets, California, Florida, because the math no longer works. Risk 2 is the float is a double-edged sword. When a bear market occurs and interest rates rise sharply, the value of an insurance company's investments can decline. Insurance companies are likely to be smarting from a bear market at the same time their policyholders are, and for similar reasons. Your float investments lose value exactly when claim volumes might be rising and customers are stressed. Risk 3. Reserve adequacy. When you acquire an insurance company, you're also acquiring its reserves, the money set aside to pay future claims. If those reserves are underestimated, that shortfall is now your problem. Discovering that a prior management team was too optimistic about their loss projections is a very unpleasant billion-dollar surprise. Risk 4. Regulatory fragmentation. U.S. insurance premiums written totaled $1.76 trillion in 2024, and the country accounted for 59.1% of the entire global OECD insurance market. The American insurance market is enormous. It is also regulated at the state level, not the federal level. That means 50 different sets of rules, 50 departments of insurance, 50 different reserve requirements. If you operate in multiple states, which you will, you are subject to all of them simultaneously. Risk 5. Health insurance specifically. If you thought property and casualty was complex, health insurance is a different category of difficult. Direct health insurance premiums written almost tripled from $459.3 billion in 2013 to approximately $1.2 trillion in recent years. The volume is massive. But so are the regulatory, political, and claims complexity risks. One change in federal reimbursement policy can reprice your entire book of business overnight. So, you've got $1 billion, you want to buy an insurance company. Here's what you're actually buying: the legal right to hold other people's money, invest it for years before it's due back, collect premiums on risks that may never materialize, and keep the investment income the whole time. The U.S. insurance industry sits on nearly $9 trillion in invested assets. The float is real. The machine works. But the machine has teeth. Catastrophes don't follow models. Regulators in 50 states are watching everything you do. The bear market hits your investment portfolio exactly when everything else is going wrong. And if you ever get the idea, even a small one, that the float is your personal investment account, there's a Yale-educated man sitting in federal prison who tried that and found out that the FBI was already in the room. Buy an insurance company for the right reasons, and you might have the most elegant passive money engine in American capitalism. Buy it for the wrong reasons, and you get 12 years and a $1.6 billion restitution order. The product is literally called insurance. Turns out it doesn't cover that. If you like the video, you can subscribe if you think you can know more about other things which you want to own in your little life. Goodbye.